I'm Taylor Riggs in New York, in for Emily Chang. This is Bloomberg Technology. Coming up in the next hour, Tesla setting a new record for quarterly vehicle deliveries, easily beating analyst estimates. The company stock soaring. Plus, we speak with billionaire investor Mike Novogratz. As the price of Bitcoin posed major swings in the past few months, he tells me his approach to the roller coaster ride. And JPMorgan Chase is expanding its use of artificial intelligence. The bank's asset management arm is planning to invest in machine learning hedge funds. But first, our top story, it is all about Tesla. Now, shares are climbing in after-hours trading, looking at the largest gain this year after the electric car maker set a new record for quarterly vehicle deliveries. Now, Tesla handed over about 95,000 vehicles to customers in the second quarter, beating the average analyst estimate of 88,000 units. This is all due to accelerated shipments to Europe and China, and U.S. consumers rushing to buy Model 3 sedans before a federal tax credit shrank in half. CEO Elon Musk had told employees in an internal memo last week that the company was close to setting an all-time record, urging them to, quote, go all out in the last few days of June. Joining me to discuss is Bloomberg's Max Chafkin in San Francisco. And here on set with me is Bloomberg's Craig Trudell. So, Craig, let me start with you. From my perspective, it seems like a broad beat across the board. Are we finally in the all clear?
I think on the Model 3 side, I think you have to separate the lineup a little bit. On the Model 3 side, this quarter was just a blowout quarter, and I think exceeds everybody's expectations. I do think you sort of had this up and down quarter where we kind of hit a trough of everybody getting really concerned about demand for the Model 3. And toward the end of the quarter, you started to see some of the analyst commentary pick up where people were a lot less concerned about that. But on the Model S and Model X front, they still have a problem there. So 95,200 was the total for deliveries. Less than 20% of that, about 17,650 of those, were Model S and Model X. And those are the higher margin, higher priced vehicles in the lineup. And so that's sort of what remains to be seen here is just how much this big jump in deliveries was at the expense of profitability.
Max, give me your take over there in San Francisco. You heard Craig say it's good news, but you wonder about the profitability. Is this a clear win for Elon Musk, or do we still face some clear headwinds on the horizon?
I mean, anytime you kind of blow the estimates out of the water this way, I think you have to look at it as a win. Coming into to the end of this quarter, you had sort of two concerns. One was demand, as Craig said. The other piece was kind of logistics. Could Tesla literally get these cars to people in a timely and cost-effective manner? And so I'd say on the logistics piece, they're performing well despite some acknowledged difficulties. Now, on the demand side, as Craig says, the real question is here, like, what happens in the long run? So you obviously have consumers in the U.S. kind of rushing to buy these Model 3s now, take advantage of this tax incentive, which is going to shrink. And you also have people, as he said, not buying the more expensive cars. And again, we just don't know how this will shake out. I mean, Tesla is still a relatively new brand. It'll be interesting to see what happens when, if and when they refresh these luxury lines. That could be just the thing that causes, people who are Model 3 buyers to want to trade up.
Craig, that tax credit, as it shrinks in half, how much of a headwind was that this quarter? And then, I should say tailwind, excuse me. And then going forward with that tailwind removed, how much do car sales slow?
That's going to be big question on the conference call for earnings in a few weeks, right? Because this tax credit is going to go from $3,750 to $1,875, and what we saw at the end of of 2018 was the fourth quarter was the previous record for deliveries, and a lot of that ended up being in hindsight, a lot of consumers going out to buy the Model 3 and the S and X before the tax credit. At that time, it was $7,500 before it was cut in half. And, I think people sort of underappreciated how much of that was demand being pulled ahead into the fourth quarter of last year. And that was part of what fueled this big drop off in the first quarter of this year. And so that is the big question for the third quarter is, can they sustain this momentum with the Model 3, even with this smaller amount of support from the federal government?
I now want to bring in David Wiston, I should say. He's a Morningstar analyst joining me from Chicago. David, we've been having a discussion here where it seems to be like we are in the all clear. Model 3s coming in better than expected. From your fundamental analysis, fold in here for me the demand and profitability mix of the S and the X, which are key given those are higher margin cars to get Elon that profitability to where he needs to be.
Right, and for all this controversy around the demand problem, I've never believed there's a Model 3 demand problem, but the S and X, it's getting to be old to consumers, so to speak. They do have a new upgraded range on the S of 370 miles, but you're right, volume is one thing, but it's ultimately about profits and cash flow. We won't know until we get the Q2 results just how much a shift to 3 over the S and X matters. S and X year over year, despite these good numbers, and they were good numbers, S and X year over year was still down about 21%.
David, what does your analysis say right now in terms of the path to profitability for Tesla? We've heard Elon Musk talk about this a lot. When do we get there?
Well, they did it for a couple quarters last year. It's not impossible. It's hard to say exactly what is the tipping point, though, because they're still growing internationally. You've got the China factory coming online. They'll have a European factory, and you've still got more new models coming out. So the trick is, how do they balance profitable growth? That's very hard for any startup business to do, and they're a pretty big startup now, so to speak.
Craig, is the Chinese demand where it needs to be?
I think the demand we don't really know at this point, in part because they aren't set up with that factory that was just mentioned that's going up near Shanghai. So once they do that, they will avoid these import tariffs that affect any car that is built outside of China. And so we don't really have a true sense of demand for Teslas in China because they're so priced out of the market. I think there is sort of a buzz within China of this brand and this aura around Elon Musk that we see around the world, but we don't really know yet just how much sort of untapped potential there is for China. As David was saying, we also that isn't something that's going to come for free. It costs some money to build up a plant. They're doing a lot of borrowing with local banks there, so there's a possibility that it won't have a huge drag on the earnings of the company. But that is something that's going to be more of a 2020 story as we see local production start of the Model 3 there.
David, as we look forward, of course, to the end of 2019 and 2020, what do you see as the biggest left side tail risk downside? Is it Elon Musk's tweets? Is it profitability? Is it the fact that they need to go out and raise more cash? Is it demand headwinds? What do you see as the biggest left side tail risk event?
Probably two things. One is just general economic risk, and that applies to any company, really, in any industry, just the business cycle. We are late cycle for auto sales, for example, but at the same time, that's a new product. But the other point would be a bigger, longer-term happening of what happened in late May and early June when the sentiment and the fear started to get into this name. This is a name that's always traded more on option value and what is it going to look like in 2025 and 2030. And it's always been Elon is awesome and all that, and he's a brilliant guy. But when all of a sudden people start to freak out and say, oh, they actually have a lot of debt, and they have about $3 billion in debt due between now and 2022. Some of it's convertibles, though, so it could get paid off. But if all of a sudden the street looks at more of the downside reasons to fear Tesla rather than be optimistic about Tesla, the stock will get pounded pretty hard.
Well, a wonderful roundtable dissecting all things Tesla. Thank you to Morningstar's David Whiston, Bloomberg's Max Chafkin, and Craig Trudell for joining me. And coming up, Bitcoin resumed its fall today before stabilizing at around $10,000. We speak with billionaire investor Mike Novogratz about the slump next. This is Bloomberg. Now to a story we continue to watch. Bitcoin stabilized at around the $10,000 level after a sell-off erased much of the monster gain from last week. Meanwhile, a battle over Bitcoin has erupted on Twitter. The contestants, economist Nouriel Roubini and BitMEX co-founder Arthur Hayes. Bloomberg's Rashad Salamat caught up with both in Taipei.
Listen, it's been around for 10 years. 10 years, what are the killer apps in this space? There are none. 75% of these distributed apps, what are they? CryptoKitties, casino games, and literally Ponzi games.
What's going on here? He was questioning your finances, and you got rather fragrant with him, didn't you?
I mean, he's a hater. He's a no-coiner. He's been bashed.
A no-coiner?
A no-coiner.
Is that the new pejorative word for people who don't believe
Someone who doesn't have any Bitcoin and watched the price rocket in their face over the past few years. So,
it's a bit harsh, isn't it?
I think so, but I think it's true.
The two will face off in a head-to-head debate at the Asia Blockchain Summit on Wednesday. But to discuss the fall in price action today and who is not a hater is Mike Novogratz of Galaxy Investment Partners, who joins me now over the phone. Mike, great to have you. First, to kick things off, give me your take on the recent price action that we've been seeing. A lot of volatility. What do you make of it?
Well, listen, we had a spectacular rally, right? We were around $4,000 per Bitcoin, say 2 months ago. We traded up as high as 13.8. And so the last $3,000 of that was really a parabolic move where everyone got excited. And they got excited for real reasons. They got excited because of Facebook. They got excited because of Uber and MasterCard and Visa all saying, hey, we want to participate in the cryptocurrency world. And so all of a sudden this went from guys like Nouriel Roubini saying, hey, this is all, tulips, to the biggest companies in the world say we're going to participate, on top of Yale and Harvard and Stanford's endowments participating. And so all of a sudden, the question around institutionalization has been answered. And now it's a question of taking, the time to build out the systems. And so people are rushing in. They're rushing into front-run institutional accounts. And things got a little bit carried away, and now we're in a consolidation. So we've kind of went up to 14,000, back down to 10,000. I think we're at 10.8 right now. And I think you're going to see the market consolidate between 10,000 and 14,000 for a while before it takes off the next leg higher. And the next leg higher probably comes from the new wave of institutions, the state of X, the state of Wisconsin, or the Texas Municipal Teachers Union, until those guys start coming in. And then you'll see Bitcoin, go towards the old highs, 20,000 and higher.
Well, when you say parabolic move, our ears perk up. Talk to me about when you sold, which was arguably, in hindsight, a very smart decision. You said that you wish you had sold more. What is your next price at which you'd be another seller?
Listen, it's someone that's out of context. By the time I was on TV, the market had fallen 20%. So, of course, I'd wish I'd sold more. I did think we had gone parabolic. There was too much energy in the market, and I think we're going to consolidate. And, we're buyers. I'm a buyer below. I trade a portion of my core Bitcoin position all the time. I don't think I'm selling the next time up to 14,000. I think, the next time we get up there, or the second time we get up there, it's probably closer to 20,000. And so I don't expect that in the next few weeks. Quite frankly, I probably don't expect it towards the middle to the end of the fourth quarter. And I think we're going to see this, like I say, a kind of a period of consolidation. But what's interesting is, Nouriel lost the debate. I was with him in Las Vegas and bet him when it was 6,000. A year from then it would be higher. He's lost the debate because all the big institutions, Microsoft is building their identity solution on the blockchain. And these are big companies.
Right. So talk to me more about critics like Dr. Nouriel Roubini, who came out at that blockchain summit and said that he doesn't believe in it because there's massive amounts of price manipulation. How do you respond to that?
You know, listen, it's a new technology, and there's lots of hype around it, and so there has been price manipulation. It's being weeded out, right? You're getting exchanges that are being regulated. You're getting real players in the game. You're getting more and more pipes, ways for people to participate, right? TD Ameritrade, pretty soon you're able to buy Bitcoin on your TD Ameritrade account. That's a big, big deal, right? Because the general population hasn't signed up and got a Coinbase wallet yet or a Circle wallet yet. And so what we're going to see over the next 3 months, 6 months, 12 months, 18 months is more and more ways you can buy this stuff. I would bet you within 2 years, MasterCard and Visa accept Bitcoin with their credit cards. Visa has 50 million merchants worldwide. The fact that they're part of this, Libra, the Facebook coin called Libra consortium, is a huge statement.
So talk to me about Facebook's entry into the crypto market. Does it give Bitcoin and other cryptocurrencies legitimacy?
Yeah, it completely does. It completely legitimizes this whole idea of cryptocurrency, and it doesn't really compete against Bitcoin directly. Facebook is working on creating a stable, what I'll call a stable-ish coin, something to be used for payments. Currencies need to be relatively stable to be used. Otherwise, why would I spend a currency if I thought I was going to be worth a whole lot more in 3 months? And so you need lower volatility to be a payment currency. And so Bitcoin, I think, actually is legitimized by being a real hard asset. It's got a fixed supply. It's very difficult to change the rules around Bitcoin. And so it becomes like a digital gold. And people don't own enough of it yet. And so I really see the price going significantly higher over the next couple of years as everyone buys just a little bit of Bitcoin.
What is there? You say the price would go higher over the next couple of years. Do you have a call?
Like I said, I think if we can get to the old high by the end of this year, every Bitcoiner will be pretty happy. But once you take out 20,000, right, it opens up, 40,000 next and much higher over time. When I think about Bitcoin, it's probably got about $160 billion market cap right now, $150 billion market cap. Gold's got an $8.5 trillion market cap. And so Bitcoin has a long way to go before it replaces gold. And it has very similar features, right? Gold's got a limited supply. You can take all the gold that's ever been mined in the history of the world and fill it in 3 Olympic-sized swimming pools. And so that's kind of a crazy statistic, right? We could build a cube of gold in Central Park, and it would be worth $8.5 trillion. Hard to get your mind around, right? And we don't use gold for much. Jewelry, some, but most of it sits in vaults. And so Bitcoin, think about it as a digital gold.
Who do you see as the next big companies entering the market? We've talked about Facebook, MasterCard, PayPal. Who are some of the other big companies that you see really starting to make an investment?
I think you're going to see in time the investment banks need to move into the space. And, we're trying at Galaxy to carve out our niche before they all show up. But at one point, the foreign exchange desks are going to trade dollar yen and the euro and the Great British Pound and Libra coin and Bitcoin and Ethereum, and they're going to just be parts of the financial infrastructure of the world. And so I do think the investment banks are probably going to end up moving into the space sooner rather than later.
You mentioned Ethereum. Talk to me about the divergence in price action that we've seen of Bitcoin, which is having a really big move year to date. Some of the other cryptocurrencies like Ethereum and Ripple, not so much. What's your take on the divergence of the price action?
Listen, Bitcoin has carved out a really interesting lane, which is digital gold. And it doesn't need to change to fulfill its mission. The way it is today is perfect to be digital gold, right? And gold's got a big market cap. Ethereum is fighting to be what I'll call Web 3.0, this decentralized supercomputer that will process tons of transactions. It's a really ambitious project, and it's not finished yet. There's a lot of technical work that needs to be done for it to scale properly, for it to be usable, on a wide range of things in a very fast way. And it's also competing against lots of other projects. And so the market got more rational. They say, okay, we still like Ethereum a lot. We like lots of its competitors, if it's EOS or things like Definity and Algorand that just launched, and Telegram is coming up soon. But they're all fighting for a different piece of the pie than Bitcoin is. And I think while it's a big, big pie over the long haul, we're 2 to 3 years away from really seeing traction of real growth in that lane.
Finally, Mike, cryptocurrency regulation, do we need more of it?
You know, we need smarter regulation. I think there's a wake-up call. Right? When you think about regulators, who do they talk to? They talk to institutional people. And all of a sudden, regulators, like Visa and MasterCard, are going to say, guys, what are you talking about? This is important. And so regulators are going to take a much different look than they did 2 years ago. I think around the world, Facebook shocked regulators. There will be a market for money, and that gets lots of central bankers nervous and finance ministers nervous. And so I think we need smarter regulation. I think the U.S. is falling behind. They know they're falling behind. Europe, quite frankly, is ahead of the U.S., and there are places like Singapore and Bermuda. Bermuda's got this amazing insurance industry down there. They are now setting up the rules and regulations for a crypto and digital industry, where you'll see a lot of companies base themselves out of Bermuda. And so I think it's time for the U.S. to pick up the pace a little bit. My own sense is we're not going to see big changes at the SEC until Carney moves on and we get the next head of the SEC. That's a gut sense, but I'm hoping it happens faster.
Well, wonderful comments on all things Bitcoin and regulation. That was Michael Novogratz of Galaxy Investment. Thank you for joining me. And coming up, more on Bloomberg Technology next. Stay with me. This is Bloomberg. AT&T is considering whether to sell its regional sports network as part of a plan to reduce debt. Bloomberg has learned that the four networks could fetch up to $1 billion. A sale would include the TV rights to teams such as the NHL's Pittsburgh Penguins and the NBA's Houston Rockets. And Facebook is the latest tech company to come under EU antitrust scrutiny. The European Commission has reportedly sent questionnaires to Facebook's customers and competitors about a range of practices as it seeks to determine whether the social network uses its size to squeeze out competition. Officials are also looking at Facebook's sales platform and how it uses and shares data from the apps. Coming up, a Bloomberg Scoop next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Taylor Riggs in for Emily Chang. Now to how U.S. chipmakers press the White House to ease the ban on Huawei. Bloomberg News has learned that President Trump's decision to allow U.S. companies to continue selling to Huawei followed an extensive lobbying campaign by the semiconductor industry. The main argument, the blanket ban the Trump administration imposed in May could hurt America's economic and national security. In multiple high-level meetings and a letter to the Commerce Department, U.S. chipmakers argued for targeted action against Huawei instead of an overly broad restrictions. For more, I want to bring in Bloomberg Technology's Ian King in San Francisco. Ian, I kept hearing that Huawei was a national security threat. How are these chipmakers now making the case that it's not?
Yeah, I mean, that's a very good question, Taylor. They're not outright saying, look, we need to give Huawei a pass on this. They're not saying everything's okay. What they're saying is that the action or the nature of the action taken by the US is actually being counterproductive, that by basically hurting US semiconductor makers in their largest market, that's going to create a situation whereby US security is threatened because this country needs a very strong chip industry. China is their largest market.
What has been the reaction from the Trump administration? To me, it seemed like a little bit of an about face.
I mean, as we've all heard, there's been various things have been said. The message has been refined somewhat. But I think it's safe to say that everybody is still sort of scrambling, trying to really find out how this is going to work out once it gets to the actual policy and rules stage. So nobody really knows, but at least from the initial pronouncements, the tweets and so forth, it seems like the administration has at least accepted a certain percentage of the lobbying that was presented to them.
You talk about targeted action versus an overly broad restriction. How targeted? What are the targeted issues?
Yeah, I mean, what the chip industry has said is that, look, something like a computer memory chip, which Huawei consumes a ton of, cutting off orders to Micron, which is based in Idaho, is only really helping Korea because they can get exactly the same product from Samsung. So what they've argued is, like, don't do that. Don't hurt us in that very broad sense. Look at other more specific things. For example, there are elements where just providing a chip to Huawei is only part of the equation. The actual engineering support, the software that makes that chip a crucial component of an end device is arguably just as important. Maybe we hold back that support, give them the chip, see what they can do with it, but really just holding back that support and that engineering expertise is arguably more important.
We talk about the massive lobbying effort that is underway by these chip makers. Which chip makers were most involved?
Yeah, I mean, we have to be a little bit careful about our sources here. And you saw some of the companies that were mentioned in passing. Really, the SIA, the Semiconductor Industry Association, has been the sort of the front man for this whole effort. But that's an industry, organization that represents companies like Intel, companies like Micron.
And if you come into my terminal here at GTV Go, I'm taking a look at the outperformance of the stocks relative to the S&P 500, which arguably is a gauge on sentiment around how the trade war is going. May, of course, massive underperformance in red. And then June goes up, and now July, we're sort of just struggling to hold in there. How would you say the chip makers now feel about this? Can they call this a win, even though the market maybe isn't quite sure?
Yeah, I mean, there are a number of factors at play here, and I think you made a good way of outlining them. Look, year to date, chip stocks are up. The money has come into the sector, and that's clearly a bet on all of this blowing over and things returning to normal. If you talk to analysts, particularly some of the more negative ones, they're saying, look, nothing's ever going to be the same. China has had an abject lesson on what it's like to be cut off from US technology. They are already finding ways to live without the US, so this has already caused fundamental problems. And if you look at some of the earnings reports, some of the outlooks, it's not been good, and it's all been down to this trade, it's all been down to the Huawei issue. So you have an element of the stock market, perhaps, at least in some people's eyes, being overly optimistic about a resolution here.
Well, thank you. These days, it is all about trade. That was Bloomberg's Ian King. Now, I want to switch on over to another story, and that is the battle among Uber Eats, Grubhub, and DoorDash and Postmates for a share of the rapidly expanding U.S. market for online restaurant delivery, and it is likely to intensify in 2019 and 2020. Now, food sales and third-party delivery marketplaces may reach $38.5 billion in 2019. That's with around 40% of order volume still offline, leaving a lot of room for growth. Now, Uber Eats recently announced it partnered with leading digital food ordering platform Olo. It's a 14-year-old company that powers online ordering for more than 60,000 restaurants across 300 different restaurant brands. To discuss the food delivery landscape, Tom White of D.A. Davidson, who currently has a neutral rating on Uber. So let's talk specifically about this deal with Olo. How does that fold into your analysis of how important or what sort of a game changer this is for Uber and Uber Eats?
Yeah, I don't know that. First of all, thanks for having me. I don't know that I would characterize it as a game changer per se. In some ways, you might even argue that Uber's a little bit late to maybe inking this partnership. As you mentioned, this company's been around for a very long time. It's had a lot of It's had a lot of success already penetrating, really deeply penetrating the day-to-day operations of over 60,000 restaurants in the U.S. These restaurants rely on Olo's platform to power online ordering for the websites of brands like Chili's and Applebee's and Five Guys, which is a personal favorite of mine. Yep. Also the mobile apps. What this is going to do for Uber is, A, it will expand their reach of restaurants a little bit in the U.S., but more importantly, it'll improve the outcomes, we think, for consumers who make orders on Uber Eats. So Olo will ensure that the Uber driver arrives at the restaurant's location just as the food is ready. And so, you'll have less likelihood if you're a diner who uses Uber Eats that the food's going to arrive cold, things like that. But a lot of Uber's competitors in this space have already signed up with Olo. So I think this is it's certainly a positive for Uber, but probably not a game changer.
So a positive for Uber, but not a game changer. How does Uber Eats fold into Uber's core business in terms of how much Uber needs Uber Eats for future growth?
Yeah, so on the growth side of things, Uber Eats is by far and away the fastest growing part of Uber. I think how it folds into the business is that Uber sits alone amongst these online food delivery companies in that they do offer a multi-product offering on their platform. So they offer ride sharing, obviously, they offer Uber Eats, but what that potentially can bring over time is a more liquid marketplace and sort of synergy advantages that maybe some of the other pure plays in food delivery don't have. So you'll have a lot more riders sort of on the network. That should reduce wait times potentially, and just a more liquid marketplace overall for both Uber Eats and for the ride-sharing business.
The path to profitability is ever elusive for companies like Uber. How does Uber Eats help Uber get profitable?
Right now, it's not helping at all. In fact, it's probably the biggest drag on profitability at Uber. Only time will tell. The problem with Uber Eats is that Uber is fighting a lot of different battles in online food delivery in a lot of different markets, some of which are equally, if not more competitive than the domestic market here, where you've already got well-established players like Grubhub and DoorDash, as you mentioned. So, for the near term, we don't think Uber Eats is going to be a helper on the profitability side of things. It's going to be a drag. If this company is going to make meaningful steps towards profitability, it's going to be in core ride sharing. And even there, the near-term outlook is pretty cloudy.
When we talk about Uber Eats and core ride sharing, we always bring in elasticity, stickiness. How do they slowly start to wean customers off of subsidies in both sections, really?
Yeah, well, it's going to be tricky, to be honest, because they're trying to promote things like subscription offerings, loyalty programs to really sort of increase stickiness and loyalty to the platform. But at the same time, there's potential that they may actually also have to raise prices on users over time. It's something that the company, Dara, the CEO, has sort of signaled broadly that they're not looking to do. But you look at some of the developments on the driver classification issue. So what's happening in California right now, where there's a bill working its way through the state legislature that drivers may have to be classified as employees. That will raise costs. It's gonna make it difficult for Uber to get to profitability without having to raise prices. So certainly an area to watch.
Is Uber Eats the single factor or the most single factor that differentiates Uber from, let's say, Lyft?
Product mix-wise, yes, certainly. Geographic mix is another. Lyft is obviously a pure play, kind of on the North American market. I would say the other big differentiator is what's happening in autonomous vehicles. Uber is making making a much heavier investment in autonomous. You could argue that that's a good thing, that it puts Uber potentially better control of its own destiny longer term when it comes to autonomous driving systems, whereas Lyft may have to be reliant on other providers or other partnerships to power that. But I'd say those are the three main differentiators.
So with the neutral rating, not necessarily bullish or bearish, what's the biggest headwind for Uber?
Look, I think right now investors are struggling with visibility. So this is a company that really hasn't given much in the way of forward guidance. Over the next 12 months, they've given some long-term targets on their IPO roadshow, which I don't think many investors are giving them much kind of benefit of the doubt for at the moment. But with all of the competitive battles that it's fighting on many different fronts, in many different parts of its business, it's tough to get comfortable with kind of the near-term trends. Whereas Lyft, by contrast, it's a little bit of a simpler story. The trends are a little bit more established, and so we just feel a little bit better about the visibility there.
Well, next time when we have more time, we'll have to battle it out between In-N-Out, my personal favorite, And Five Guys. Thank you. That was D.A. Davidson analyst Tom White. Thanks for joining me. And coming up, Washington is coming after big tech. But how will smaller startups be affected by the crackdown? We'll discuss the impact of new tech regulation on venture capital next. This is Bloomberg. Between data privacy scandals and escalating tensions with China, tech's reputation has taken a big hit in Washington. More and more U.S. regulators are calling for increased oversight of tech companies. And while Huawei and Facebook may dominate headlines, it is not just the tech giants that are being affected. Washington's crackdown could trickle down to startups, investors, and early stage companies. Joining me now is Trinity Ventures principal Allison Baum. And Allison met with regulators at the VCs to DC conference with the National Venture Capital Association to discuss the consequences of tech regulation. So, Allison, I first have to ask you, what was the key theme or your key takeaway from those meetings?
The meetings were very tense, and I had two real key takeaways. One is that big tech is the new Wall Street. So nobody in Washington quite understands what they do, but they all agree that they need to be regulated. The second is that the trade wars are escalating, and so national security is a priority. So regulators are really using whatever tools are at their disposal to make sure they're demonstrating to constituents that they're taking action to protect American interests first.
In what areas within your space is trade hitting you the hardest? I know within big tech, we talk a lot about the chip makers, for example, who are affected by Huawei. What areas or companies do you work with that are being hit the hardest?
The two key areas that are being affected most that matter, I think, for the ecosystem, one is immigration, and the second is foreign investment in U.S. startups. So the number one kind of conversation that we were having when we were in Washington was around this previously obscure government agency called CFIUS, which is the Committee for Foreign Investment in the U.S. And previously, CFIUS's purview was very limited to large technology transactions where foreign companies were buying controlling stakes or merging with U.S. companies. But since the trade wars have been heating up, the purview of CFIUS has expanded. And now basically every single startup in the tech ecosystem risks being caught underneath their regulatory purview.
I wonder, how do these small companies price in this new risk, especially when it comes to CFIUS? It's a hard to measure risk, but one that needs to be done. How are these companies factoring that into their price and future growth expectations?
Yeah, I think your question really highlights a key point, which is that most regulators aren't thinking of how this affects very small companies. So, where prices are very opaque, most of the regulators, when they think about technology, they're thinking about very large companies like Facebook or Google that have prices that can be measured and an impact that can be measured in dollars. But what's happening now is that because the scope of CFIUS has been expanded to include not just controlling stakes, but also minority investments, it affects any company that's taken even a small amount of money from a foreign investor. So, these regulators, they don't know what the impact of their changes are because they're not meeting these small companies. I'm talking about 10, 15-person startups that are based out here that are hustling day and night to make ends meet. They don't have the time or the resources to go to DC and actually explain how if you can't take money from a foreign investor, or if you need to file for approval 30 to 45 days before you accept any capital, it's actually a matter of life and death. It's not just a pricing issue.
Allison, it was very interesting in my conversations with some big tech leaders. One of the points they made when they were perhaps being probed or looked at being broken up was the domino effect on these small companies who traditionally their buyout option, instead of an IPO, you just look to get bought out by a Google or a Facebook. With some of the big tech antitrust regulation, these small companies are worried that they no longer have an exit strategy. Do they have an exit strategy if a Google or a Facebook can no longer buy them out?
I think certainly your point is, and whoever you are talking to, their point is absolutely true. There is a limitation to exit opportunities when you're changing antitrust laws or when you're changing the ability for foreign entities to come in and buy U.S. companies. But what I'm really concerned about is actually much, much earlier in the life cycle of a company, which is that before a company can actually exit, you have to go through multiple rounds of funding. You have to hire talented people, and a lot of that has been is being stifled now. So it's not even a matter of exit opportunities; it's a matter of new companies being started.
Sorry, go ahead.
No, I mean, the irony of all of this regulation is that the intent is really to protect the U.S. economy and the U.S. companies and U.S. interests abroad. But what I don't think a lot of people realize is that our superpower is really our innovation ecosystem and our ability to launch and scale new companies that can actually change the world. And when we're actually preventing them from starting in the first place, we're really, really handicapping ourselves when it comes to competing on the global stage.
Allison, sort of just ending it here, broadening it out and ignoring some of the tech and regulation conversations we've been having. As you look within the venture capital space, how has the funding environment been? Are there specific tech companies that are doing better? Is it all about AI and cloud? What types of tech companies are having the easiest time raising capital?
Yeah, I think there's a lot of capital in the ecosystem right now, so it's less of a concern about certain types of companies having challenges, but more about the scope of this kind of regulation having an impact on new companies being started. So artificial intelligence is certainly something that a lot of people are talking about, but the days of unfettered growth in these areas have certainly come to an end, so it's definitely a concerning trend.
Trinity Ventures Principal Allison Baum, thank you for joining me.
Thanks.
And still ahead, why JPMorgan is expanding into machine learning hedge funds, furthering its tech arms race with Morgan Stanley. This is Bloomberg. JPMorgan is pushing its use of artificial intelligence beyond investment banking. The bank's asset management arm is planning a strategy to invest in machine learning hedge funds. This is all according to a person familiar with the matter. The vehicle will operate within JPMorgan's $15 billion fund of hedge funds business. For more, we are joined by Bloomberg's Hema Parmar. So, what is the purpose? Walk me through this.
Right, so machine learning is what they're focusing on here. JPMorgan starting what's called a fund of hedge funds, meaning it's going to invest in hedge funds. Specifically, they're focusing on these machine learning funds. Unclear how sophisticated of a machine learning strategy they're seeking for these managers, but they can be from more emerging also to more established. This really is like the next push for JPMorgan. Them alongside Morgan Stanley have been investing a lot in these kinds of technologies, using AI, machine learning in their investment bank, and they've been hiring up quantitative talent from hedge funds as well too. So really interesting to be investing in a fund of machine learning hedge funds.
So I remember in 2008 and really in the past decade, it's all about quants, right? Quants were all the rage. Yes. How is machine learning different from, let's say, a quant fund?
So machine learning is a subset of artificial intelligence, and what it does is they use these algorithms that are programmed to adapt and improve upon themselves. They're supposed to learn from themselves. Sometimes they try to mimic the way the brain uses neurons to create layers of learning. Quantitative funds, well, they use great swaths of big data, mathematical models, very advanced mathematical models to dig through data, but they don't necessarily learn from themselves.
The purpose of a hedge fund of funds is arguably diversification. With a big hedge fund of funds, you can get diversification across a wide variety of different hedge funds. Within the machine learning space, though, I wonder what's the size and scope, because it's arguably a pretty small industry, right?
So what's interesting is fund of funds as a whole not doing necessarily too well because there's a second layer of fees that tends to happen within fund of funds. Within machine learning funds, you're seeing a lot more funds really push into the strategy. And if you're looking for an edge and an opportunity, you may say, hey, well, let's gather some of the best machine learning funds into one pool. Let's make a bucket of these funds things, to say. And then if we pick the best ones, maybe that will be fruitful down the road.
So all we care about is performance. How has performance been?
Right. So so far this year, they've lost a bit of money if we look at AI machine learning funds. But over the longer term, say over the past 5 years, AI machine learning funds have outperformed some of the other computer-driven strategies, up about 7%. Meanwhile, CTAs or managed futures is about a third of that, and the average hedge fund about 3.6%. So.
And quickly here, you mentioned that JPMorgan is getting in after Morgan Stanley. Who are the other big players that we know of in the machine learning hedge fund of funds space?
It's a smaller space. We don't see too many fund of funds launching at this point. We don't see, we do see a greater interest from allocators in machine learning strategies because it's so hard to find an edge nowadays if you're a hedge fund. And so everyone's trying to push into new territory, get new data, figure out new ways to clean it up and dig into it. So we'll have to see how this does.
Always about the new landscape. Thank you. That was Bloomberg's Hema Parmar. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. And be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.